Welcome to Talk Tickers, your shortcut to being well-informed about the financial world.
We get right into it.
Today, we're diving deep into Meritage Homes' Q2 2025 earnings call. We'll sift through the numbers, the management commentary, bring you what really matters.
Yeah, this quarter was, it was fascinating. You had Meritage showing really strong operational execution, some smart strategic moves.
Right.
But then, stark contrast, you saw clear market skepticism, mostly driven by profitability trends. We should unpack that tension.
Absolutely.
Yeah.
Because they actually reported numbers that beat analyst estimates, didn't they?
They did, yeah. Largely surpassed them.
But the market, it just seemed to fixate on other things, specifically, to the bottom line impact.
Mm-hmm.
So our mission today, cut through that noise, figure out what truly mattered. Let's dive in.
Okay.
Let's kick things off just a quick snapshot. The headline numbers for Q2 2025. Meritage Homes reported GAAP EPS of $2.04.
Right. Generally accepted accounting principles, standard stuff.
And that $2.04, it beat consensus estimates by what, about 5 to 7 cents?
Yeah, roughly in that range. And revenue looked good, too. Came in at $1.616 billion.
Which also topped estimates by about $16 to $26 million.
So you look at that on the surface and you think, okay, solid beats, pretty healthy top line.
Right.
But the market reaction told a different story, didn't it? Hinted at something deeper worrying investors.
Okay.
So home closings were up, but only slightly, just 1% year over year.
And flat, basically.
Pretty much. But the average selling price, the ASP on those closings, that dropped down 6% year over year to $387,000.
Ouch. And that ASP drop, that flows right into margins, which, as you said, seemed to be the big sticking point.
Exactly. That was the focus. Home closing gross margin landed at 21.1%. Or if you back out some land walkaway charges, about $4.2 million worth, it was 21.4%.
What are those walkaway charges quickly?
That's basically when they decide not to proceed with a land deal they had previously planned on, maybe because the numbers don't work anymore. They pay a penalty.
Got it. So 21.1% or 21.4%, how does that compare?
Well, that's the key. It was a substantial drop, 480 basis points lower than last year. That's 4.8 percentage points. That got attention.
Yeah, you can see why. Any bright spots operationally?
Well, orders were up, increased 3% year over year to just over 3,900 units. And their absorption rate, sales per community per month, was 4.3. That's actually pretty healthy. Shows people are still buying in their locations.
Okay, so demand is there, but they're paying for it with price and margin.
That seems to be the story.
Despite all this, you mentioned they ended the quarter financially strong.
Yeah, pretty solid.
Yeah.
$930 million in cash, net debt to capital ratio, only 14.6%. That's quite low.
And they returned cash to shareholders.
They did. $76 million between dividends and share buybacks.
Okay, so putting it all together, the market reaction.
Telling. Shares traded down about 6% on the day of the call. Volume was high, too.
So investors definitely noticed.
Oh, yeah. They were clearly honing in on that margin compression. Even though revenue and EPS beat, it really signals this kind of cautious neutral feeling out there. Profitability seems way more important than just top-line growth right now.
All right, let's dig deeper then. Given that market focus on margins, what exactly is Meritage doing? What are their strategies? And how are they impacting this profitability picture?
Okay, this is where their model gets, really interesting. A huge part of it is their move-in ready spec strategy, building homes before a buyer is signed.
What, spec homes?
And that approach. It allowed for an incredible 208% backlog conversion in Q2.
Whoa, wait, 208%? How does that work?
It means they closed more than twice the number of homes they actually sold during the quarter. They're bringing through their existing backlog really, really fast because the homes are already built or nearly finished.
That's incredibly fast.
Yeah, it speaks to their efficiency. And they've improved cycle times, too.
Yeah.
Cut construction down from about 120 days in Q1 to around 110 days in Q2.
So what does that efficiency mean for, the person looking to buy a house or someone investing in Meritage?
Well, for the customer, especially one worried about rising mortgage rates, it means certainty. You can get a quick closing, often within 60 days. That's a massive advantage compared to buying an older resale home where the closing might drag out, and you definitely don't get builder incentives.
Right, you lock in your rate faster. It's like a clear play for market share then.
Absolutely. It positions them really well against the existing home market.
But how are they growing overall in this tougher market? Are they expanding?
They are. They hit an all-time high for their ending community count. 312 active communities, or stores as they call them. That's up 9% year over year.
And they expect that to continue.
Yeah, manager was clear. They reiterated their outlook for double-digit community count growth through the end of this year, 2025, and into 2026.
Where are they growing? New cities.
Mostly expanding within their existing markets, getting bigger where they already are, but also some targeted scale-up in newer spots like Jacksonville, Utah, the Gulf Coast.
Okay, community growth sounds good. That agile strategy seems effective for volume. But we have to circle back.
Yeah.
Those ASPs and margins keep coming up. What is really driving that pressure? Is it just competition?
It's primarily affordability. That's the number one barrier, especially for the entry-level buyers' Meritage targets.
Right.
So to combat that, they are using financing incentives quite heavily, particularly rate buydowns.
Explain rate buydowns quickly.
Sure. The builder, Meritage in this case, pays upfront points to the lender to lower the buyer's mortgage rate for the first few years, or sometimes the life of the loan, makes the monthly payment more manageable.
Okay.
And management literally called these buydowns the most attractive offering in the majority of our markets. They need them to keep sales going.
But there's the catch, right?
There's the catch. While they're crucial for keeping the sales pace up, these incentives directly eat into the average selling price, which in turn crushes the gross margin. It's this constant trade-off. Keep selling homes today, but sacrifice near-term profitability.
It literally sounds like they're walking a tightrope then. Volume versus profit.
That's a perfect way to put it. A very fine line.
Okay, let's give it slightly. Financial discipline. How are they managing their money, their capital allocation, when margins are under such pressure?
Well, they're showing discipline, but also flexibility, which is interesting. They actually cut their planned full-year land spend.
Oh, really? By how much?
Stopped the target from $2.5 billion down to about $2.2 billion, cited, economic uncertainties.
So pulling back $500 million from future growth investment, what do they do with that freed up capital?
Allows them to be more flexible elsewhere. And a big part of that seems to be returning cash to shareholders.
Which we saw in Q2, right?
Yeah.
$76 million returned.
Exactly. Dividends and buybacks. They repurchased over 674,000 shares just in Q2 for $45 million.
And did they say why they were buying back so much stock?
Yeah, they explicitly mentioned the current undervaluation of our stock as a reason to buy back more than their usual program might dictate.
So pulling back on land, but leaning into buybacks, that's quite a signal. Confidence in their own shares, maybe?
Could be seen that way. It's definitely a strategic rebalancing. They're saying, right now, buying our own stock might be a better return than buying more land, given the uncertainty.
And they also walked away from some land deals.
They did. Terminated about 1,800 potential lots in Q2. That resulted in the $4.2 million walkaway charge we mentioned earlier.
So they're willing to take a hit now to avoid potentially bad deals later.
Shows discipline. If a deal doesn't meet their current underwriting standards, even one they previously liked, they're cutting it loose.
Okay, shifting gears again. Cost structure. What are SG&A? Selling, general, and administrative costs. How are those looking amidst the revenue pressure?
Well, SG&A as a percentage of revenue actually went up. It was 10.2% in Q2 compared to 9.3% last year.
Why the increase?
Few reasons they mention. Higher commissions paid out, costs associated with starting up new divisions, carrying costs for the increased spec inventory, utilities, maintenance on finished homes waiting to sell,
right?
And also just some lost leverage because the average selling price is lower. The A in SG&A is tied to revenue.
That makes sense. Lower revenue per home means fixed costs take up a bigger slice,
yes,
percentage-wise.
Exactly. It's mathematical to some extent.
But were there any cost savings?
Yes, on the direct construction side, they actually reduced direct costs by over 1% per square foot compared to last year.
How'd they manage that?
Benefited from lower lumber prices, finally. Also higher volumes, helping with negotiations, better vendor partnerships, and just better labor availability than, say, a year or two ago.
And what about that SG&A percentage long term? Is 10.2% the new normal?
Management says no. They reiterated a long-term target of 9.5% for SG&A.
Okay.
They think they can get back there once closing volumes normalize. They even mentioned exploring AI opportunities to streamline operations, find more efficiencies.
Interesting. Let's go back to that gross margin. 21.1% this quarter. Big drop. But management is still sticking to a long-term target range of 21.5% to 23.5%, right?
They are, yeah.
That feels optimistic, given where things are now and the heavy use of incentives. How credible is that target?
It's a fair question. Their argument is that the 21.5% to 23.5% is for normal market conditions.
What's normal there?
Good question.
Yeah.
But they believe it's achievable because their underlying business model is more efficient now than pre-COVID. That target is about 300 basis points, or 3%, higher than their pre-pandemic margins.
So they think structural improvements support it.
Right. They feel even a small pullback in incentives from what they call the current above normal levels would get them back into that target range. So yeah, Q3 guidance is low, around 20%, reflecting ongoing incentives, but they see a path back long term.
Okay. Last piece on the current situation. The buyers. What do they look like? Are they stretching to afford these homes?
Actually, buyer quality looks pretty good still. FICO scores are holding strong in the 730s. Yeah. And debt-to-income ratios are around 41, 42%. Also pretty reasonable.
So what does it tell you?
It's crucial. It suggests the current slowdown isn't because buyers aren't qualified. It's more about weakened consumer sentiment, as management put it.
Psychology, then. The sticker shock of rates.
Seems like it. Less about affordability based purely on credit metrics and more about buyers feeling hesitant or spooked by the rate environment. There are qualified buyers out there, but they might be waiting on the sidelines.
That's a really interesting dynamic. A pool of qualified demand just waiting. Okay, let's look ahead then. What guidance did Meritage actually give for Q3? And what are the big macro trends shaping their view?
All right, for Q3 2025, they're projecting closings between 3,600 and 3,900 homes.
Okay.
Revenue guidance is $1.40 billion to $1.56 billion. And that home closing gross margin, expected around 20%.
So even lower than Q2's 21.1%, confirms those incentives are sticking around.
Seems so. And diluted EPS guidance is between $1.51 and $1.86 for Q3.
Now, the big thing here, they didn't give full year guidance, did they?
They did not. Only guided for Q3.
Why the limited visibility? Investors usually hate that. Is it just their strategy or something else?
Well, management's explanation tied it directly to their strategy and market conditions. They cited volatility in the market and their high backlog conversions.
Because they sell homes so fast with the spec model.
Exactly. Their accelerated move-in ready approach means they have, and I quote, little visibility beyond the next quarter. They even said they have 0 closings identified yet for Q4.
Wow. So they literally build and sell quarter by quarter almost.
Seems like it. And they also noted Q3 is usually one of their lowest volume quarters anyway. Spring selling season orders pulled closings into Q2, and July is typically slow.
So you could read it as just a function of their agile model. Or you could read it as them being genuinely uncertain about the back half of the year.
You absolutely could. It doesn't exactly inspire confidence about Q4, even if it's explained by the strategy.
And the macro picture isn't helping that uncertainty, I imagine.
Not really. Mortgage rates were still volatile, around 6.6% in late August when they spoke. Builder confidence, that NAHB HMI index was still really low, 33 in July, 32 in August. Anything below 50 is considered negative territory.
So the near term really does hinge on rates and whether buyers keep responding to incentives.
Pretty much. It's all about interest rate direction and incentive effectiveness right now.
What about competition from existing homes? We hear inventory is rising there. Is that hurting Meritage?
They acknowledged the increase in resale inventory, but downplayed it a bit, said it's not necessarily a head-on competitor in all of our markets.
Why not?
Their reasoning is that a lot of that resale inventory isn't entry level, which is their focus. It might be older, need work, and crucially...
No incentives.
Exactly. Resale sellers typically don't offer rate buydowns. So Meritage's new homes, even with slightly higher list prices sometimes, can end up being more affordable monthly because of those financing deals.
Makes sense. It keeps their product compelling, especially for that rate-sensitive buyer. So, summing up the market reaction again.
Yeah.
Beat on top and bottom line, but the stock drops 6% because everyone's laser focused on those compressed margins and falling ASPs due to incentives.
That's the gist. Sentiment is definitely cautious neutral. It highlights that tension perfectly. Strong operations versus profitability pressure.
Okay, we've laid out the current situation, the strategy, the pressures. Now for a bit of fun, the "this is not financial advice" segment. Let's play what if. Given everything we've discussed, is there an outrageous, maybe even slightly wild, but still plausible scenario or trade idea related to Meritage?
All right, let's think about this. Meritage is agile, they've cut land spend, they're sitting on cash, and they're committed to buybacks when they think the stock's cheap. which they clearly do now.
Okay, setting the stage.
Now imagine the Fed surprises everyone. Let's say some really soft inflation data comes out late Q3, and the Fed didn't just do a little 25 basis point cut. No, they go big, maybe 50, maybe even 75 basis points. Aggressive.
Wow, okay, that would send shockwaves.
And mortgage rates, which have been stubbornly high, suddenly plummet, maybe into the low fives, even high fours temporarily. What happens then?
Buyers rush back in, especially those sensitive ones who are waiting.
Exactly. That pool of qualified buyers we talked about, they jump off the sidelines, and Meritage, with all that move-in ready spec inventory,
suddenly doesn't need to offer such heavy incentives.
Precisely. They could pull back significantly on those rate buydowns almost overnight. What does that do?
Margins shoot up rapidly.
Bingo. Immediate sharp gross margin expansion. Maybe they even get back towards that higher end of their long-term 21.5, 23.5% target way faster than anyone expects.
Okay, so the market is punishing them now for margin compression.
Uh-huh.
But in this scenario, that flips entirely. And they've got the community count growth, the buybacks boosting EPS.
It's a potential slingshot effect. Their agile model, the spec inventory, the strong balance sheet, it positions them perfectly to capitalize if that macro environment flips hard and fast. It becomes a margin expansion story, turbocharged by falling rates and their capital return actions.
So, the trade idea.
Maybe something like a highly leveraged, short-dated call option strategy on Meritage, ticker MTH, expiring maybe mid-Q4.
High risk, high reward. Betting on that specific macro trigger.
Very high risk. If rates don't fall, or worse, go up, those options could expire worthless pretty quickly. But it's a bet on sentiment turning on a dime, catalyzed by a Fed pivot that unlocks all that latent demand and profit potential inherent in Meritage's specific strategy. It's betting that their current pain point, the margin hit from incentives, becomes their biggest leverage point if rates fall.
That is definitely a thought-provoking scenario.
Yeah.
And certainly not financial advice.
Absolutely not. Purely hypothetical speculation.
So to recap our actual analysis, Meritage Homes in Q2 showed impressive operational agility, smart strategic positioning with their spec model, but faced heavy investor scrutiny over margin compression. It's all about those incentives in this market.
Yeah, their ability to cut land spend, boost shareholder returns, keep growing communities, that's the core story. But it's overshadowed right now by the margin pressure.
The path forward really does seem to hinge on that delicate balance, doesn't it?
Mm-hmm.
Maintaining sales pace versus getting those margins back up, likely needing help from falling interest rates.
It really does. It shows how complex interpreting these earnings calls can be. You have to look way beyond the headline beats or misses.
Absolutely. We hope this deep dive has helped you understand the moving parts with Meritage Homes a bit better. Again, that trade idea, purely speculative, do your own research.
Please do.
Thanks for joining us on Talk Tickers.